Now let's bring in Invesco's Brian Levitt and Capital Area Planning Group's Malcolm Ethridge. Malcolm's also a CNBC contributor. It's great to have you both with us. Thank God Levitt didn't publish today. He'd be all over him. Now
he'd be dunking on me.
He would. He might in your face.
I mean,
let's see if he has that.
Not much of a dunker. Let's just be clear.
No, and the reality is, the reality is, I was, to be fair, I was sitting here nodding my head with Adam. The reality is,
you scoff at some of the
I'm not
negative.
Concerned about seasonality. I mean, I agree with Adam with regards to valuations. You could be wrong for a long while with valuations. They give you far more information about the intermediate to long term. Valuations should never be considered timing tools.
Are you as bullish as he sounds?
Yeah, I'm optimistic. I think when we talk about risks, the one thing I would be worried about here is if inflation's, if prices are going to move up, but does the bond market start to get a whiff of broader inflation? If not, if inflation stays stable, expectations stay stable, I think the Federal Reserve eases in an environment where the economy will slow a bit, but it's not showing signs of cracking. Corporate bond market's not showing signs of cracking.
No.
It suggests to me that you continue to want to be in risk assets.
I mean, there are some calls that I've seen that suggest, Adam, that bonds are going to be better in August than equities.
Look, they could be. Listening to that comment about sort of meme stocks, heavily shorted, just ones that ripped. I mean, I think the challenge for most institutional investors is it's hard for them to market to their allocators that they own low quality stocks, right? And so what is ARK? ARK is a, hyper growth junk, low quality proxy. It's had a huge run. Low quality stocks have outperformed high quality for 3-4 months, and that's hard for people to keep up. So maybe the bullish thing is that, these things sort of, get sold and we get back into some of the higher quality names that could lead.
But if they do continue to get sold, does it make the market more fragile because you have a rush to the exit on an already shaky leg of a four-legged chair?
The institutional investors were buying Kohl's and Open last week. After they go 50 to 150 on a retail short squeeze, it's all targeted and would be illegal if it's institutional investors, but it's fine if it's retail. The retail guys are all looking at options activity and volume and price, and they're squeezing it higher to $150 to $250. That's what the hedge funds do, and they're chasing it. But none of those stocks, any kind of real investor who turns the book over once or twice a year buys Kohl's when they all know it's going to be as weak. I told you 2 years ago it was going to zero. It's pickleball courts. So like those things, Open, nobody buys Open. It's a 50-cent stock. If you're short a 50-cent stock with 50% short interest, you're asking for problems from the risk management perspective, right? Like that's a tough short. So I look at that and think it will be helpful to most institutional investors if we stop seeing that kind of meme 3.0 short squeeze stuff and we get back toward the fundamentals. I think some of the top half quality growth names will actually benefit in the second half of the year.
I mean, it's not a short-term streak, Malcolm, that some of these stocks have been on. The ARK ETF had an 8-week win streak before last week. We've had the high beta ETF pacing for a fourth positive month in a row. That's the best streak in 3 or 4 years.
Yeah, I don't know that we could paint with a broad brush and say what happens inside of the ARK ETF is indicative of what we're talking about with the memification of some of these names that were penny stocks a couple days ago, right? I know Kathy Wood does a little bit more research than that. And so I think we should at least separate those two categories. But I do think what we're seeing is investors taking profits that they earned from April 9th on through June and using those profits to invest in some of these more speculative things. And that's part of the reason that we're seeing this reset that you guys started by talking about. And it's probably going to carry through the rest of this week's earnings, even after we get bang up numbers from some of the hyperscalers in the Mag 7. The market will likely respond with a little bit of a yawn, similar to big bank earnings that kicked off the earnings period.
Brian, are the mega cap tech stocks, are they tired? Are they exhausted? Are they just resting before the pause that refreshes after these earnings this week?
Probably the resting before the pause that refreshes. I mean, some of this low quality, high risk stuff, that's not indicative of the macro environment that we're likely heading into. We're heading into an environment where growth is likely to moderate, prices are likely to move up, Fed can't do much of anything. We shouldn't be fishing in the lowest quality waters in that type of an environment. I think investors are going to move back. Higher quality in this country tends to mean mega cap, growthier tech names. And you can't paint Mag 7 with one brush, but a lot of them are well positioned.
But you're talking about prices moving back up as a result of tariffs, like an inflation issue.
Yeah, but more
keeps the Fed on hold.
Potentially keeps the Fed on hold. More of a price shock than an inflation issue. But the challenge is exactly the Fed caught between a rock and a hard place. Growth slowing. Probably want to respond to that. We probably shouldn't be sitting with a flat yield curve, but they have to pause because of where the consumer price index is going.
But don't you think that companies are going to be more reticent to pass costs on, and they're going to eat it and figure out a way to do so, even if it comes at the expense on a small degree to their margins?
Well, there's probably a combination of both that will happen. Obviously, there's a cost to tariffs. Some of that will be absorbed by businesses. Some of that will be absorbed by the consumer. My fear in it would be if you start to see inflation really start to accelerate to the upside. That's a different story. That's end of the cycle.
We can't put that to rest at this point.
Well, I think you get a price shock on tariff-impacted categories, but not broad-based across the economy.
I'm not that worried about it, only because we all do this. I do this too, of recency bias, where we say, wow, we had massive inflation in the COVID recovery. But you remember, we did this payment protection program, helicopter money, so not only were factories shut down, but we also had massive, high nominal GDP, the highest in our lifetime, basically. So we don't, as you said, we don't have that strong of demand side. So I don't think we're going to have inflation that high. And kind of back on Malcolm's point before, just to be clear, I'm not saying anything about Cathie Wood individually as a researcher. I'm just saying it's a factor bet. When you show me that high beta stocks in the CNBC index are up a lot in 4 months, or we have Trivert has this hyper growth junk tag, or ARK is massively underperformed any kind of comparable index over a long period of time, because really it's just a giant factor bet on high beta, low quality growth stocks. And when you get regimes like around the election last fall, or since beginning of Q2, really since Trump said buy stocks in early April, they've worked. Normally, and I think what's hard for institutional investors is you don't really get sustained low quality rallies unless you're kind of near a recession bottom and you're expecting incremental accommodation from the Fed or incremental fiscal. So what makes this junk rally and the magnitude of it a little challenging is it's happening at a time where the economy is slowly getting worse, not where we dream it's accelerating. That's been tricky. Some of it's been retail manipulation on the meme stocks, and some of it's just been more risk taking. But look, we didn't mention it yet in this hour, but we're seeing some M&A pick up again, and that's usually a bullish indicator.
That's a good point,
as well.
Including Malcolm, the headline today regarding Palo Alto. So IPO markets picking up, got some M&A activity. Maybe we are getting long-delayed animal spirits finally manifesting themselves.
I would agree, and I think once again the bank earnings were a precursor to telling us that, right? We saw significant increases in deal-making revenues. The prices that each one of the banks, the toll that each one of the banks collects each time they help make one of those marriages happen. And I think what's happening specifically with Palo Alto and CyberArk is interesting, because I've been making the case for a while that there can only be 3 or 4 as far as the standalone cybersecurity firms are concerned. And there's several out there that offer 1 or 2 products and aren't necessarily a platform company just yet. And so I think it's really interesting to see one of the largest by market cap going ahead and taking out one of those standalone companies if the deal does actually go through. And I think that realistically we have to consider that it's not just about those 3 or 4 names that'll become the most dominant in the space competing against each other. They're also competing against companies like Microsoft and Google Cloud, Amazon Web Services, for example, where security is just a feature. It's not necessarily the service that they're offering.
Brian, last thing for you on the return of animal spirits. What that means for the market. We're talking about catalysts. What are the catalysts? We already know about taxes. We already know about deregulation. We know what's going on with trade for the most part. We don't know the degree that you're going to have a deal-making environment that is bullish.
Well, we know about a resilient economy. To Adam's point on inflation, my recency bias is not 2022. It's more 2018, 2019, where it fades quickly. And you're starting to see good signs of animal spirits. You're starting to see M&A activity pick up, more names coming through the IPO market, all positive. This feels middle cycle in the mid-cycle. This does not feel late cycle.
We'll leave it there. Malcolm, thank you. Brian, thank you.
A little lathered up today. I get some more sleep next time.
I don't know.
That was fun. See you, Malcolm.
You got some extra hot sauce in your lunch today.
Yeah, exactly.
Adam Parker.